I don't understand why so many people are ignoring this data. This is the stablecoin market cap. It shows how much money is flowing into the ecosystem and out of the ecosystem. It shows potential growth rates, but also gives interesting data points to time the market. This chart starts at the end of 2021. Sometimes we see inflows into the market, sometimes we see outflows. Since October of 2023, the market is expanding. Now this chart is useful for two reasons. First of all, it's not just another random indicator. It actually shows us what's going on under the hood. Are people currently moving from the fiat ecosystem, from the regular traditional finance ecosystem into the crypto world, or are they rather withdrawing from crypto and going back into the traditional finance world? So whenever this is going up, that means people are transferring money to maybe a centralized exchange, say Binance, and then Binance sends it over to a stablecoin custodian. The stablecoin custodian takes the funds, buys US treasuries with it, and then issues the equivalent amount of stablecoins on the blockchain. So whenever this is going up, we see deposits into the ecosystem. And the same is true the other way around, right? Whenever this is going down, people want to get back out of the system. They are withdrawing from Binance. They actually want to get money into their bank accounts again. And so the chart is useful for exactly that reason. Are we currently in a period of contraction or in a period of expansion? I like this chart because it's way less volatile than crypto prices. Crypto prices go up and down. This is now the Bitcoin chart. And while the curves don't align perfectly, they still give us an idea of when it makes sense to be more risk on. So the little volatility of the chart is great. Every day, or at least every week, there's new money getting into the space. But another reason why this is so useful is because we can get a growth rate. Let's say we take our current data point and we look at that 1 year ago. How quickly did the stablecoin market cap go up since then? So in a span of 12 months, the answer is 65%. This, by the way, is also a logarithmic chart. So this is accelerating over time. 65% in a year. Let's then compare this, how quickly Bitcoin appreciated during the same time period. The answer is also around 60%. So this is 62%. So isn't that fascinating? If we don't see any kind of systemic collapse, if we don't see something like FTX going under, or if we don't see an implosion like Terra Luna, which started the last bear market, if we don't have anything like this, we should expect Bitcoin to go up by 60 or 65% per annum. That's how fast money is flowing into the space, and this simply translates into price appreciation for cryptocurrencies over time. So a stablecoin market cap is useful to figure out in what macro trend we are in. But it's also useful to time the smaller scale movements. How high or how low are we currently in the medium term for all of crypto? Because here's the thing, most people have heard of a metric called the Bitcoin dominance. So that measures the market cap of Bitcoin relative to the entire market cap of the ecospace. But very few people have heard of the term stablecoin dominance. How much of the current cryptocurrency market cap is currently in stablecoins? And I'd argue that this is actually an even more important metric. So when the stablecoin dominance is high, it means a lot of dry powder is on the sidelines. There could be still a lot of capital flowing into the space. When the stablecoin dominance is low, then there is no dry powder on the side. The market is already fully deployed. Have a look at this chart. This is the stablecoin dominance. And initially, we simply saw more and more adoption of stablecoins over time. But then there was a saturation point somewhere around the end of 2022. And since then, the stablecoin dominance went down or moved in a trading range. So that trading range was established in the last 1.5 to 2 years. We traded between 9% of all of crypto being in stablecoins and 5% of all of crypto being in stablecoins. Now, when this is very low, it means that the market is fully risk on. There isn't a lot of stablecoins that could get deployed. When this is very high, it means the market is very risk off and we might be at a medium term bottom. Now let's compare the Bitcoin price during those extreme events. So stablecoin dominance is low, Bitcoin price is high. Stablecoin dominance is high, Bitcoin price is low. Again, the stablecoin dominance is rather low. It bottomed around here. The Bitcoin price was high. And then have a look at this point in time right here. again, it was a great time to buy at that point. And so currently, unfortunately, we are not at either extreme in this chart. We are rather at the upper end, which is good, because if the stablecoin dominance was to fall to its historic low, the Bitcoin price would go up, but we are not at extreme levels in the dominance. There's a case to be made that we could potentially fall even further in the Bitcoin price. Now the macro, of course, is bullish. We do expand by more than 60% per year. But if we want to time the micro as well, we can just look at how much are people currently deploying that capital that's getting into the market. From one high risk point to the next, we see the Bitcoin price going up, because again, money is flowing into the space. The same can be said from one point of depression to the next. The Bitcoin price went up. So the long-term trend, as long as money is coming into the space, is bullish. And the tendency should be to rather buy than sell. But we should buy even more once we are around here, and then potentially take the levels when we are at the bottom here for profit-taking opportunities. And so I'm very much interested in what's happening with the capital that flows in and out of crypto. Most people get this backwards. Most people just look at the Federal Reserve, they look at interest rates, they look at the money supply, but those are all just second-order effects. The first-order effect is just how much capital is in the crypto ecosystem. When M2 goes up, when the money supply is going up because interest rates go down, this will then translate into stablecoin growth as well. But why should we measure the growth of all of capital across all markets when we've got the capital specific for the crypto ecosystem already ready at hand? Here's another chart, the aggregate stablecoin supply over time, and this time it's split up across different issuers. So we've got USDC, we've got USDT, and this of course grows over time, but we did have our contraction with Terra Luna. But what I find interesting is that the number of stablecoin transactions is growing even faster. It's growing even more consistently. Here's the market share in terms of supply. There's no clear winner. There's no clear long-term concentration. It seems like USDC is taking over slightly more market share over time, but it's definitely taking over more transaction count over time. So USDC is the most transacted stablecoin across all of crypto. Much more than Tether, even though Tether has a higher market share in terms of issuance. It simply just gets transacted less on-chain. Now, what causes this long-term growth in the stablecoin market cap? Is this more and more speculative money? So more and more investors that speculate on various altcoins that's causing this growth? Or are there some people that hold stablecoins long-term? You might know a similar metric for Bitcoin. Here it is for stablecoins. Here are the HODL waves. So how long are stablecoins held? We've got the very short-term trading, we've got the more long-term holding. And when we just isolate the stablecoins that have moved in the last 24 hours, we actually don't see that much growth. So over the last 4 years, this maybe grew from peak to peak at the same rate as monetary expansion, of course, including some volatility. It clearly didn't grow at the rate we measured over here. But once we exclude those very short-term stablecoins, we actually do see a long-term adoption. So it seems like the vast majority of stablecoin growth comes from accounts that tend to hold stablecoins a bit longer. The stablecoins that haven't moved for the last 6 months account for roughly 70 billion of the market cap. And while the total market cap is close to 250 billion, the growth really comes from the medium-term holders, not necessarily from short-term speculation. At least that growth is slower, comparatively speaking. So what's then the use case of stablecoins? It seems like it's not just short-term speculation of people buying and selling altcoins within the week. It seems like some people are using stablecoins also as a decentralized Swiss bank account. So finally, a way to store wealth without having the identity directly pegged to that wealth. So the Swiss bank account becomes democratized. Now, who's using that Swiss bank account? Have a look at the wealth distribution waves. So now we're looking at the stablecoin market cap depending on the holding size. How many dollars are in a particular wallet? Let's exclude the big guys. Let's exclude all the wallets that have more than 10 million worth of stablecoins. Now we are seeing something extremely interesting. We see constant growth. So really, it was only the big guys that exited the crypto ecosystem. If you've got less than 10 million worth of stablecoins, you are part of the majority that simply adopts the technology over time. And again, there seems to be no long-term concentration process. What we see in dark purple, that's the amount of stablecoins that are held by the wallets that have at least 10 million. And the 10 million plus 1 to 10 million tend to be at a somewhat steady level. They own around 75% of stablecoins. In other words, if you've got less than $1 million worth of stablecoins, you're actually not that important to the price discovery. The game is played by the millionaires and multimillionaires. They make prices. Your 100k portfolio, it doesn't do anything to the market. Here's a proportion of supply held by wallets that have up to 100k worth of stablecoins. It's roughly 10% of the supply. Now, most people try to beat the market by reading the news or by following the narrative of the day, but I don't think that that's a good approach long term. Most people just follow their gut. I think it's better to use statistical data analysis. Try to figure out what kind of rules worked in the past that might continue to work in the future. So you might know about this. I have back-tested moving averages for Bitcoin to try to find out when are we bullish, when are we bearish. It's a trend following strategy. We buy whenever we are above the moving average. We sell whenever we are below the moving average. Now I've back-tested all moving averages from the 2-day all the way to the 200-day. And the 125-day simple moving average and the 44-day simple moving average are the ones that historically work the best. That's the two moving averages we see plotted over here. So the 125-day is the line in turquoise, the 44-day is the line in orange. Now have a look at the historical performance versus buying and holding Bitcoin. So we are betting on rising prices whenever we are above. We're betting on falling prices whenever we are below. This is the 125-day. Buying and holding Bitcoin would have given us this performance here in white, but the backtest gave us the performance in turquoise. Here's the same for the 44-day simple moving average. We can see, first of all, that we outperform long term, but also that our volatility is lower, as in the drop from top to bottom is less compared to buying and holding Bitcoin over the same time period. Now, when we've got an approach that tends to perform more and still is less volatile, still drops less compared to just buying and holding Bitcoin, why don't we lever this up? So I tried to find the optimal leverage. If you go long, the best leverage is 2.75. If you go short, the best leverage is just 1x. If you have the same leverage for both directions, long and short, then 2.25 is the best. But in general, I think it's better to have different leverages to go harder on the long than on the short. So this is the 125-day simple moving average. If we only go long, we never go short. So whenever we are below the moving average, we're just in cash, we're just going sideways. And here is the short side. So we never bet on rising prices of Bitcoin at all. We're only betting on falling prices. And of course, that underperforms buying and holding Bitcoin. But still, it shows us that even though in a long-term appreciating asset, if you can only bet on falling prices, we can still make some return. And so let's say we use the 44-day simple moving average, but we don't just have 1x leverage. So that's that. But instead, we lever this up with 2.75 on the long side, with 1x on the short side. This is much better than just going 1x. And again, this is a logarithmic scale, right? So each horizontal line here is at 10x from each other. So that's my preferred medium-term approach for Bitcoin. I just look at where is the price currently relative to those moving averages, and then I position myself in the long or short direction. And because this might be cumbersome, this might be complicated for a few people to always enter and exit those trades, I've also opened up a capital trading pool for the premium members. They can simply just deposit capital and then I will execute that exact strategy and I won't deviate from that strategy. So if history is any indication, we might get performance that looks similar to that over time. At least that's the idea. We don't want to just follow the news or act based on gut fear. We just follow rules that historically worked well. This was a very quick rundown, but there's way more details in the tutorial section of Premium. The link is down below. It's webitcointrader.com. But I'm also sharing my personal view on the market regularly. So every 3 to 4 days, I publish a premium update video where I share what kind of trades I open, where I share what kind of positions I take. There are more details regarding the strategy in premium. There are dedicated videos for that. There are also dedicated videos that explain how to actually run the backtest, how to make those backtests yourself, if you want to do this maybe for Ethereum or for any other crypto asset. And so here is the Bitcoin strategy moving average vault. So that's the trading pool. You just deposit some money into that pool and then I will execute those trades automatically for you. So feel free to check it out. It's currently $125 per month. There's also a 1-week money back guarantee. So in case you do not like premium, just message me within 1 week and I will refund you 100%, no questions asked. A link to premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.